Happy Friday, everybody. Welcome to the 5th episode of Real Assets Weekly. With me, as always, my esteemed co-host, Jimmy Wang. Jimmy, what's up, my man?
Happy Friday, Turtle. Always good to be here. Beautiful end of April, right in the middle of earnings season. We got a lot to talk about. We got a great guest today. I'm just going to talk shop, talk about Latin America. So happy to get started.
Yeah, me too. Excited for that. And let's introduce our guest, Ian Bezek, and lives down in South America. He's a Seeking Alpha and Substack publisher, former Carisdale Capital analyst, and quite frankly, one of the hottest names on Fintwit. So if you don't know Ian by now, that's on you. And what we can use this opportunity just to talk to Ian about some real assets, talk to him about some earnings from last week, and most of all, pick his mind. I think he's the axe on LatAm stocks. So let's talk to him a little bit about the setups down there. Mm-hmm. So with that, Ian, how are you, my man?
I'm doing well. Thanks for the invite. Happy to be here.
Yeah, Real Assets Weekly goes global. So it's cool to get you on here, and I really appreciate you coming on. And let's have some fun with it. I think a great place to start, just kind of the as is tradition of every finance podcast you ever listen to. Talk to us just a little bit about Ian. I mean, here's from what I understand, the genesis is I've been reading your stuff on Seeking Alpha for a long time. Based on other podcasts I've listened to, I think you're like some sort of savant character that out of what in high school you're writing Seeking Alpha articles that about Chinese frauds or something. And tell us about how that started and how that got you into Carisdale, because that's a big deal. Genesis of Ian.
Yeah. So I went a fairly unusual route into investing, and so I studied economics at a state school, not a target school, but just really loved the finance side of things, and so I was just kind of studying stocks and investing my capital, my college fund during the 2008 crisis, which was obviously a very interesting time to get started in the market. I started looking at some of these companies, that Chinese listed companies that looked really cheap. They'd be trading at like 3 or 4 times earnings. They looked like tremendous bargains, and so I was wondering like what's going on, because you looked at any comparable companies anywhere else in the world, they traded at way higher valuations. And then when you read the 10Ks, there's weird stuff like one company I wrote about, the revenues tripled, but they didn't hire any more employees and they didn't spend any money on capex. And so you're just like, what's going on here? And so I just raised some questions on some of the stuff I was looking at. And the fund that ultimately hired me, Carisdale, had been short one of the stocks I was writing about. So they said, come kind of join us and see if there'd be a good partnership here. And so I worked there for 3 years.
Wow.
Excellent. How did you get started? Anything in your family, any particular macro or company moment that piqued your interest to learn more about equity research and that whole field?
So I think I became interested. My school had a stock picking competition in 1999, which was a fun time. My team, fortunately, we just bought all of the GoGo.com stocks, and so
good. Did you win?
Yeah, we got a cash prize. Yeah, we got a cash prize from the school for winning, and I was like, oh, this seems really easy. And then I was kind of watching the market, and everything that I would have invested in like crashed the next couple of years. So I'm like, oh, this is actually really challenging. It kind of spurred a lifelong interest.
Sure.
So you're from the East Coast originally?
Yeah. My parents are from New York.
Yeah. So you're working at Carisdale. You're living in Manhattan, living in New York City. I
was living in Queens to save on rent.
There you go.
Kind of I'm from Queens. Investor. Where in Queens were you from?
So when I was working at Carisdale, I was living in Astoria.
Got it. Very cool.
So you're so from Seeking Alpha blogger to Carisdale, what was that transition like? I'd imagine, on Seeking Alpha, you're relying solely on public filings, and you're kind of on the outside looking in relative to getting a Bloomberg, I would imagine, and kind of playing in the NFL, if you will. So maybe you can just give our listeners a little taste of what that transition was like?
Yeah, I think there probably wasn't as much of a change as you might expect, because the kind of companies that we were looking at were really small cap and did not have much analyst coverage. And so we were digging in pretty weird places to find data on them anyway. And
Yeah.
so I don't think just having a Bloomberg was kind of the thing that made it kind of gave you any edge on those companies. And so that kind of made it more interesting, frankly, because we hired Kirsten in some cases had people that were on the ground in China looking for financial data and stuff. Very kind of gave me a sleuthing way of viewing the world. Like, how do I check out is this stuff legitimate opportunities or not so? And I think that's given me a unique perspective on markets today, because I don't start from a Bloomberg perspective. I start from a what's my unique take or hunch or hypothesis that I can test or reject. I'm not sure if that answered your question.
No, it's good. No, it's your answer. It's good. It's perfect. What about some maybe the interesting is how did you get the sniff that I mean, now it's like the China, everyone kind of knows, or I mean, not everyone, but it's widely consensus to be suspicious of Chinese VIEs. But when you were originally got on the trail, it wasn't, right? And what kind of non-consensus view did you have that led you to believe that something smelled fishy over there with these numbers or with these companies in general? Because that's what Kerrisdale would, if I understand the story correctly, they're interested in your Chinese shorts, right? And that's you were very successful with some of those.
Yeah, and the case of the first couple kind of that got me into the profession in the first place. It was just going through their filings and asking, like, do these things that they're saying make sense? Like, can this company grow its business without employees? In this company that purports to be an internet company, when they're buying a fertilizer mine, is there like any successful company in the world that has decided that fertilizer and software go well together? Like, you'd see companies that, like, you'd see filings, or not filings, you'd see like stuff online saying like the regulators had shut down their software business because it had like illegal pornographic materials, and then their next quarter they would say that our revenues were the same. You're just like, I have a document here that says your site was shut down, but you're reporting to in the US that your revenues are flat. So
and just a little tuck-in acquisition, Ian. Just a little side business, right? Yeah.
So I was just asking a lot of practical questions that I think people that just saw these PE ratios just like, oh, this thing's trading at 3 times earnings, or it's trading at half of book value, or it's trading at less than its purported cash balance. People just were so excited at the upside that they didn't really ask.
And at the time that you
questions.
started, were there any notable figures that mentored you along the way? People that you looked up to, right? It's I think the financial Twitter community has definitely evolved over time, but it's been much more noticeable in the last few years. Certainly in the last cycle and prior to that, there was little, if any. Particularly you mentioned when you're in small cap, micro cap land, you're doing boots on the ground due diligence. There isn't equity research available. There aren't a lot of publicly available resources. You have to kind of bootstrap your own methods.
Yeah, I think probably the biggest help was just Kirsten had a few other analysts that had come from more traditional backgrounds. And so when I'd run into something I didn't understand or just needed more help kind of learning kind of Excel or how to use a Bloomberg, kind of the more traditional financy part of stuff, I rely on the other analysts there. It's tremendously helpful to work with other people. And I feel bad for folks now that are kind of doing everything remote or don't have the same experience of getting some hands-on people, just where you can call people over and say, my Excel is not processing, it's glitching, kind of what's wrong with my code, that sort of thing.
So then the final transition I wanted to pick your brain on is so you're in Astoria, you guys are you're hanging out with guys like Jimmy on the buy side. And then you decide, from what I heard you say on another podcast, New York wasn't for you. You're going to try you're going to try to do this from afar. And so just talk us through a little bit, like how did you come to that decision? And I mean, it sounds like one of the cool, like, hey, I'm going to go to South America and make a living on the internet blogging. Talk me through that a little bit. That's pretty cool.
You're giving me a little more credit for foresight here, whereas there was more the just kind of random acts of a 20-something person who was following his emotions or passions. But yeah, so kind of the hedge fund, we'd get, I guess, like three weeks off around the holidays every year, because our founder was from overseas and he wanted to be elsewhere for the holidays, and so we'd all kind of take off. So I would just go to a different Latin American country every winter. And I kind of the last winter I was like, I really don't want to go back to New York. It's like being sunny here at the beach. I've saved up a good deal of money, and I really want to like. It's so much fun meeting with people and partying with people like for a couple of weeks, like when you're in Mexico or wherever. But it's like I really want to learn Spanish and understand the culture and everything, and I can't do that if I'm in New York the whole time. So I just decided I was gonna go for it and spend a year just traveling. Wasn't really trying to earn money at all, just kind of traveling, and ended up meeting with the person who's now my wife. And then at some point I was like, I need to make money. I can't I can't live off my savings forever. So that kind of got me into how I could make a business out of writing full time.
Yeah, and talk to us a little bit about that portion of it. So now so when you went to Kerrisdale, I'm sure you had to shut down the blog, you shut down the Seeking Alpha corner, huh? Right? Or
yeah, I only published a few articles. I could still publish if it was about something that was totally unrelated to anything we owned, but
cool.
That didn't usually come up. And so, but I published a wide body of work before that, so I think there was still kind of it was easier to get my foot back in the door.
Dude, you're prolific. I mean, I don't know, I'm sure Jimmy, you looked at this, but like, I love how wide ranging your topics are.
Yep.
Like as far as going from what is a balanced fund to what is implied volatility to like, these Fintwit stocks to, stocks people talk about to, this, what is this, like a Colombian gas pipeline company. So I just love how prolific your writing is. I think just from, there's a lot of, I think learnings in there for just from being a proficient writer standpoint. Like if you want to publish your writings, I think, there's a lot you can learn from Ian over here. So it's pretty interesting stuff.
Yeah, at the time I was launching my newsletter in 2016, I made kind of a pledge that I was just going to publish one article every news day for the year, and I think I missed like 3 or 4 days out of whatever 250 calendar days in the year, and so that kind of gave me a good brain for figuring out what's something interesting where I can come up with an angle and I have some variant perspective that people might find interesting. And just that process of iteration, creating ideas, publishing, see what people find engaging, what people kind of think is boring, or where maybe my view isn't particularly interesting. It's kind of made it easier to have a successful operation nowadays.
That's really fascinating. I mean, you've been doing this for what, 7+ years, just on this from 2016 onwards. What have you learned that the internet space has changed so much? I think Turtle and I, we talk all the time about the rise of Substack, about, and not even talking about compliance, but just the new marketplace, your viewers. Do you have a formula of what you're looking to do when you get in? Maybe just dive a little deeper. I'd love to learn more.
Yeah, everything has changed. You used to have a huge blogging community where people had their own websites, and people kind of got a reputation for having a view on the market. You had kind of the perma bears, you had people that covered tech stocks. You had very fun communities within blogging, and that kind of went away. But in some ways, Twitter has replaced that or augmented it. But it's been very exciting to see Substack kind of give us a place to have a lot of long form writing again.
Yeah.
Kind of meet other people that are covering similar stocks or similar sectors. Yeah, I think it's been a really great development, because there's a period kind of in the late 2010s where it's kind of hard to find good quality specialized stuff, just because a lot of the old blogs shut down and there was a void for a while. So I credit Substack for stepping in there.
Do you feel that Seeking Alpha has been a good partnership for you? Have they done a good job for you of being a partner?
Oh yeah, absolutely. Yeah. Yeah, I would just say that their user base tends to be more kind of
boomerish.
More, what's that?
Boomerish?
I wasn't going to use that word, but it's, yes, kind of very much a focus on kind of dividend stocks, blue chip stocks, um, kind of a different category from the stuff we found on Fintwit. But yeah, and seeking alpha, obviously, I think their business models had to evolve over the years because it used to be an advertising-based business, and now advertising just for financial content isn't really there like it used to be. And so I know some people don't like all the decisions they've made, but I think they've done a reasonable job. It's just it's a tough business. So, I mean, you look at sites like Fortune or Motley Fool, and they all have issues with content as well.
Let's
Are you
say,
able to
Speaking of, it's not perfect,
co-publish?
but
Yeah.
go ahead.
speaking of, it's not perfect, but I think they've done a reasonable job. And I admire their commitment to always having coverage on smaller stocks. I think if you're trying to find something on an obscure holding, your best bet is probably there, at least to start out.
Yeah, totally.
I was going to say, are you able to co-publish on different mediums? You know, from the business side, how do you think about growing and evolving your research that you create?
Yeah, Seeking Alpha, in terms of their marketplace, is not exclusive. So you can have offering on Seeking Alpha and then an offering on Substack. And I think that's worked well because kind of it's a very different readership base, more younger, more professional investors on Substack.
Really.
Yeah.
And maybe to wrap around that part of the conversation, if you're a young aspiring, don't have to be young, but just an aspiring finance writer, would you recommend one versus the other, or how would you kind of think about that decision to where to publish? The little point you just made that I didn't know that Seeking Alpha was not exclusive. So that's cool. I mean, that seems like it's pretty, maybe to start with both. Like, why not?
Yeah, I think a lot of it just in terms of trying to get an idea for where your audience might be more. If you're publishing on more niche or unusual stuff, Substack is probably going to have, like, if it's an idea that resonates well on Fintwit, it's probably going to be better for Substack. But if it's something in a category like REITs or energy or high dividend sort of stuff, Seeking Alpha is probably going to have a wide audience for that. Yeah, I would tell people just publish and see what works and what doesn't. Like, that's what I was saying. I've learned so much just from publishing every day for a year and see what works and what doesn't. I see so many people that ask me, like, how do I get started in this? And they'll send me like 1 or 2 articles, and then those articles maybe they'll get like 1,000-page views, but like not really take off, and then they just quit. It's like you can't. You're not going to learn anything from publishing 1 article. You need to keep going, and it's just after a certain amount of time, the internet algorithms decide that you've done enough, you've put in enough time, and it's time to promote your stuff, and magic happens.
That's beautiful.
Excellent.
Yeah, maybe no, that's great advice, and I think that makes a lot of sense, and probably that's kind of rings true with everything else of any wall I've ever had to run through. It makes a lot of sense. Maybe a good place to kind of, there's some earnings that happened this last week. I don't know if you guys saw that. Some of our largest American institutions reported earnings for the first quarter, and maybe start with you, Jimmy. Let's go. Just want to kind of hear, like, just don't not too worried about the world of real assets. Just in general, there was so much earnings this week. Even us guys that try to filter out some of the noise had to be paying somewhat attention. So anything surprise you? What were your kind of big takeaways from this week of earnings?
I mean, I think if there's one headline that summarizes not just the price action, but maybe the sentiment around this earnings season. I don't know if you sent it to me or someone else sent it to me, but it's a funny meme. It's like, Google has finally figured out what innovation the market's really looking for, and they come with that $70 billion buyback. So Google Cloud's doing well, Amazon AWS, and you talk about some of the cloud-based SaaS softwares that people are expecting to fall off a cliff. I mean, these companies do a good job guiding to the street, and we're still in a very choppy market environment. You got the move index pulled up, whatever name hasn't done the Mount Fuji and kind of come back down. year to date, at least, when you look at the factor exposures that have really outperformed and worked, I mean, it's a lot of these 2022 large cap laggards.
Yeah.
And we're still at a point where there's a lot of fund flow, a lot of technical, movement where, again, price continues to drive the narrative. But the truth is you've got companies that are slowing, that are trading at historically high multiples late in the business cycle. And people say, hey, there's an evergreen space for some of these leading companies, and we're looking to the future, and QE is going to come back. And there's a lot of other things you can kind of mentally deal with. But I think if you want to call a spade, I continue to think that the bottom is not in, and that the real economy and the real capital market and just the relative and absolute pricing for these companies have to, well, they don't have to do anything, but I think there's still a digestion period, right? Really, for something so unprecedented as the 2020 to current period. In order to get through it, we're going to have to go through it and all its different iterations, all its different bear market rallies to lower highs, all its 16 VIX, periods. So it's a wait and see for me. And I think this first quarter was no different. I don't think there were any noticeable blowups, but I think if you're a bear or a bull, I don't think that a lot of minds were changed. Let's put it that way.
Yeah, that's a pretty succinct synopsis, I think. Yeah, Ian, was there any mega cap earnings that really kind of surprised you this week? Was there anything that anybody came out with that really kind of altered your macro view or anything? Or
I liked what Jimmy said. I get the feeling that people are looking at all these individual sectors where you see like slowing growth and relatively high multiples, and they say, I don't want to put money here. But you still have like fund inflows. There's been a lot of fund inflows, and so people need to put money somewhere. That's like they ruled out like, oh, I can't touch banks now because obviously banks are toxic. I can't touch energy. Healthcare has been kind of in a slump. And so it's just like, obviously REITs have had their issues. So it's like by process of default, you end up with money going to tech because it seems like the least bad option.
Go back to Microsoft, right?
Yeah,
It's
if
about
you're a
300
fund
bucks
manager, what was the old saying? Like, you never get fired for buying IBM, I think it was. It's kind of the same idea now that
look at that
you won't
melt
get
up.
fired for owning Fang.
Yeah. No, I think the Mount Fuji comment is very, very that's a very interesting comment as well, because for one, it's the Dr. Jim vernacular, so I'm a fan. Dr. Jim innovated he trademarked the PWL and the Mount Fuji. And so, but I think that, to your point, it's like that's, these things all got beat up. And so to some, these are the greatest, probably, high margin businesses in the world. And so for them to go on a little run, especially as rates kind of pull back, and like you said, there's at least some reprieve in the MOVE index. Yeah, it totally makes sense. I think what's so interesting is the kind of what we were talking about before we hit record, Jimmy, is like this kind of dichotomy where it's like, to your point, big picture, I don't see how we don't slow. It's like you hit this patient with so much medicine. It's like we've all taken too much medicine, right? We know what happens the next day. It's not good. And so that's, you have that aspect. And then on the other side, it's like, everyone's waiting for this quarter to be the quarter where you finally really see pain and, job loss and these like very real signs of economic slowdown, and it's just not happening. But the last comment, I think, to maybe kind of bridge those two thoughts is like the Alex Gurevich thing, that it's just, but Jerome himself always says there's time for this to flow through the system. And we raised rates a lot. It's just going to take time for this whole thing to flow through. And I think a lot of people are looking at this from an economic, they're looking at it using old, using the same barometers that worked before. It's the 1970s, or no, it's not, it's this. But it's like, it's a very unique set of time with with the pandemic and the stimulus, the pandemic and the stimulus and the response and all that. So anyway,
But yeah, two of my formative experiences, I mean, watching the market come on the downside of the euphoria in 2000, I was just perplexed because I was watching these stocks just like as a teenager and very perplexed as to how like all these things that I thought were so important had all blown up, and yet the real world economy was fine. Like if you're
Yeah.
looking, like no one
That's right.
like that didn't follow the market thought that the economy was in bad shape in 2001, and it wasn't until you got the exogenous shock from the 9/11 attacks that kind of Main Street started to panic. So was that like a nearly 18-month
Yeah.
time for things to move from the financial economy to the real world? And
Look
then
at that
obviously
Mount
2000,
Fuji. That's the original Mount Fuji right there.
Yeah.
that's right. And then 2007, obviously, I was just staring at my screen every day watching housing and banks getting blown up. I'm like, why isn't the S&P going down? And I think a lot of people had that same experience.
Well, Ian, in
Like, and
2007,
then,
I was trying to sell mortgages. I had a little side job in college, right? No,
oh wow.
no income verification. They gave me a little laptop, go out
No
there.
way.
I was prop trading my $100 in my E-Trade account and trying to sling mortgages at the same time.
What a dream.
Yeah.
Dude,
But that
you're
was
giving the
like
people
that
free
was like
money.
a
Yeah.
that was like a solid year between when the financial economy was showing serious distress in mid 2007 and when the S&P finally cracked. And so I think people just watch like The Big Short and they're like, oh, I'm going to be a genius. I'll see
Yeah.
that everything's rolling over. I'll buy some puts. I'll be a millionaire. But that's not how the past bear markets in the US or other parts of the
Yeah.
world, frankly, have played out. So I
Right.
think people just need to be patient. I'm not
Yeah.
predicting like a big crash or anything, but I wouldn't be surprised if the S&P just kind of stuck between call it 3,500 and low 4,000 for a while.
Yeah.
We just kind of see how things digest.
Again, when you look at 2000, even coming out of the GFC, as far as the real economy and the digestion in the markets, it was a multi-year process, right? The market didn't bottom out in 2003. And even as the market climbed post GFC because of QE, because of what have you, I mean, the real economy, the sentiment was so bearish up until 2013, 14. This is several years later, I think, especially coming out of this stimulus. And we talked about the K-shaped recovery, where only the top quintile of people in America are even saving. The bottom is not. The bottom 50, 60, 70% is not participating in this. But the fund flows continue to be very powerful to the 401k types and to the long-term asset allocators. So there's going to be a digestion period, no doubt.
Yeah,
Well,
I would say I was fortunate to be working at Kirstel in 2012 because if I just had been off by myself, I would have been shorting the market, thinking that the European
you would have been in
crisis was
cash
gonna
or
hit. Yeah, I would have left so much relative money on the table. But working at a fund where we had shorts and specific idiosyncratic stuff gave me the confidence that kind of my personal net worth would be fine if we take it again. But yeah, the sentiment in 2012 was awful, and yet you look back and it was like a clear bull run. There was nothing like you never lost money being long like 2009 until 2020, and yet
right.
sentiment was just the worst.
Yeah. No, and I mean, to your guys' point about about waiting, seeing the bad news, seeing the deterioration fundamentally, and then waiting for the price action to follow. I think COVID, you could say the same thing, right? It's like we're all sitting around and watching this news spread and watching things slowly, kind of these rolling shutdowns and rolling freakouts, and the S&P didn't notice for a while. There's people putting out daily YouTube channels about the virus long before there was any sort of actual sizable pullback in the stock market. And then the next thing you know, it's like they couldn't find a bottom. I think that was it's part of the reason probably everyone's been calling for a crash for the last 3 years is, not everyone, but a lot of people have been calling for a crash 3 years, is that burned in our brain memory of just the free fall that was February and first half of March of 2020.
No doubt.
Yeah,
I want to quickly
go ahead. Puts on Intel like by mid-February, maybe early February of 2020, because I concluded it was kind of something that was going to get smoked if we had supply chain problems out of China. Like I had the correct thesis, and it took like a whole month to play out, which it's an eternity when you have short dated puts. You're just like, this is so obvious. Like, look at the news. Just why are people not selling? And then finally, like, it all hits in a few days. But I think it was finally when the sports leagues quit playing that people were like, oh, this is actually gonna add it.
Mhm.
But
Yeah,
it's-
the theta burn in option land is pretty intense, right? It depends on how you're positioned, especially around these. And I'd love to pivot the conversation, I think, to some of your specialty. You know, we want to talk about LatAm, we want to talk about real assets, about land, and I think that maybe I'll kind of throw it out here that in the US, when I look at 3-month treasury yields north of 5%, it as a starting point, you know, if you're an institutional investor, if you've got capital on the sidelines, um, just on the face of that, it seems like that 5% watermark now for risk-free rates, even for a 3-month duration, is it makes a lot of risk assets kind of a no-go from an underwriting standpoint or from a risk-reward standpoint, right? Unless you have to act today and you're 1035ing something, and congrats if you actually sold something in this environment. But like, how does there's definitely an impasse, but I want to hear from you being down in Latin America, or even what you see here, you know, how does that flow into your investment thesis and what you see from a daily pricing perspective for, especially in real assets?
Yeah, so I think it's interesting, an interesting perspective living here where we've had relatively high inflation and high rates for most of the past at least 20 years, depending on
Yeah,
the country.
2 decades
In some
now.
cases, a lot longer. And so our banks are blowing up because they're accustomed to dealing with high and sudden changes in interest rates. And investors are also accustomed to getting real returns. Like I was pitching a Mexican REIT that owns a lot of warehouses, infrastructure assets, and people are just like, I don't want it because the dividend yield's only 8%, and I can get 11% at the Mexican bank, just on like 1-year CDs. But obviously in the US, people would be very happy about an 8% yielding rate, but it's just people are accustomed to having safe higher interest rates
Yeah.
elsewhere, and so
Were you talking about
yeah,
Fibra Uno or let's say Prologis, you know, Mexico as a proxy?
yeah, it's essentially something like that. And yeah, those companies have much higher costs of capital than the US equivalents. And I think the rest of the world's kind of now having, the US is having to deal with what emerging markets have dealt with for many years. And obviously we're seeing some weird repercussions in markets, kind of all these banks, for example, that didn't realize interest rates could go up.
Mm-hmm. Yeah. I mean, I guess my question to you is like, you know, from the US, we've been used to that cowbell for so long. We're waiting for those inflection points. But what if that inflection point doesn't come? What if we spend the next couple of years hovering between 3 and 5% on CPI with different pockets of inflationary pressures? And that, you know, Powell says, hey, I'm not going to take the rate down. The long part of the market's already coming down, or they're trying to price that in. But if we get this kind of 3-year yield at 5 throughout the rest of the year into 24, I wonder, you know, again, as a capital allocator, what's one to do?
Yeah, to say my general view is that instead of having a Fed put kind of where the market would, where the Fed would come to market participants' aid during a downturn, now we have essentially a Fed call where anytime the market goes up too much, they're just going to jack interest rates again or reduce liquidity. So I think investors need to shift to a model of buying all dips to trying to take some profits on the rips.
Yeah.
So that's kind of my operating framework, at least call it through the next year, and we'll see. I don't have a strong view on if inflation is just going to go back to call it 3% or if we're going to get another wave of it. I think the conditions that we've had with COVID and supply chains and now deglobalization are so novel that we're all just kind of shooting blind here, or flying blind. Excuse me.
Today's probably a good day to sell some SPY calls, maybe. Who knows? I'm just looking at the market. But you know, it's I think it's always a challenge. I think I don't know. I don't know about you. I think there are definitely periods where I've had more conviction from a bottoms up perspective. I think like you, I done a lot of personal due diligence on small caps, micro caps. That's kind of what I like to do. I love to do intense bottoms up focused fundamental research. But I think, you know, we're in a market where NVIDIA and Microsoft are getting fund flows and they're going back to, pretty high valuations, and you have other companies trading below cash, and you have pockets of asset classes where there's no institutional interest left. And so maybe there's a dislocation, but maybe there isn't, right? Maybe that has to again, get digested. I wonder how you think about risk reward in some of those scenarios. I think Turtle and I, we talk all the time about private companies have to take their marks. That hasn't necessarily happened in real estate. It's happened in tech, in the private portfolios, whether they want to or not. But effectively, a lot of these companies have gone to zero. But maybe there's something there. So maybe for the more enterprising investor, I wonder what is the most attractive place to look at. There's a bunch of graveyards now.
Just look at our longs. You want some bombed out stocks?
Some small caps, some SPACs, right?
Let me pull up my long book real
biotechs.
quick. Let's find some. I'll find some drawdowns. Yeah. What do you
I
think?
think I was just gonna say, like, of the stuff I cover in LatAm, it seems like a third of it is at 52-week highs, and the other 2/3 are near 52-week lows.
That's
slightly hyperbole, but we've got plenty of dispersion here to work with. So there's a very it's a very interesting setup. But yeah, I have more confidence just in the stuff I can find that is lower beta to the S&P anyway. I don't think. It's just the fund flows are so strong. Like, I might have a tactical view that I think Visa or American Express or whatnot is relatively well positioned compared to the market, but is anyone going to care? Because it's a large cap, and all the large caps seem to trade together unless they do something monumentally stupid like changing their name to Meta.
Right.
But it's just,
how do you incorporate technical
so
analysis into your view?
I feel like there's more opportunities in these kind of off the beaten path markets or assets where it's not just a 0.9 correlation to the SPY.
Yeah. Here's your bull case for LatAm. Hasn't done anything since 2013. There you go. So versus SPY has obviously gone to the moon.
Yeah.
That's a good question. I like that question, Jimmy. What I don't see you talk about technicals much in your posts. But I've not, but it seems like maybe do you incorporate technical analysis into your daily trading? It's
not a key element of my approach, but I certainly respect that a lot of people use it. And so like when something's been out of favor and then it starts crossing moving averages, for example, and you see volume picking up, that's clearly a sign that somebody, be it momentum funds or quants or whoever, is coming into the name. So it's definitely something to pay attention to in terms of, like, you're showing this chart here that's been kind of in a bear market for the past decade, more or less. And at some point, once money starts coming in, you're going to have a lot of capital flowing through a very small door once people want into these stocks. There have been so few IPOs, so little activity, just people haven't been bothering to raise capital down here. I think the last IPO here in Colombia was like 9 years ago.
Wow.
The stock market's essentially dormant. And it still opens every day, but it trades a very small number of shares.
Here's one way to slice it up.
At some point, and so at some point you're just going to see the volume come in, and there's going to be a lot of money to be made kind of in the middle of the trend when everything starts turning bullish, and then people say, I need to own some of this. Why do I have a 0% weight to the hottest market in the world? People will be calling up their brokers. And then once they start running ads on CNBC for the CTF, that's when you need to sell it all.
Yeah.
So that's a great way to slice it up, is like, so let's start with the ETFs, right? So high level. So maybe we start here. So ETF versus let's talk about people talk about investing in Latin America. Maybe one place they might start is with ETFs. The big one, I think the biggest AUM is this guy here, ILF, which is kind of the top 40 stocks of LatAm. And then you've got, then you got your country specific stocks. Mexico's EWW, EWZ is Brazil, GXG is Colombia, and ARGT is Argentina for our folks at home. So maybe we don't have to spend too much time on it, but just quickly, like, how do you think of investing in the ETF structure versus like doing, obviously, I'm sure if you have expertise like you do more, you'd rather put your money in the highest, the fastest boats.
Yeah,
So
like this
go ahead.
this ETF, the LatAm 40 ILF, is almost all Mexico and Brazil. I forget the exact weighting today, but it's like 55% Brazil, like 35% Mexico, and like 10% to the rest of the continent, something to that effect. And so if people are buying it and thinking they're getting a representative basket of everything listed down here, that's not really the case. I mean, it's market cap weighted, so that's fine because Brazil and Mexico have by far the largest economies. But if you have a particular view on like copper or lithium or kind of the opportunities in Colombia or whatnot, you should be looking at the individual ETFs rather than just owning a basket that's probably not going to give you the exposure that you're expecting. So I'd certainly say at least focus on a country ETF level. But then, yeah, I think it makes sense to look at the individual stocks. In many cases, there's not that many individual stocks listed in New York anyway, and so you're just owning 3 or 4 tickers, so you can get a lot of what's in the ETF anyway.
So
this has subsequently changed, but for many years, the Colombian ETF, the top 3 holdings were 40% of the ETF. So
right.
you could just buy those 3 and then not pay the ETF management fee, which is like 65 basis points a year.
Right.
And you'd get a very similar return.
Right.
How would you characterize for Colombia? That's your backyard. How would you characterize the nature of the market over the last few years? Has it been fundamentally driven? Is it fund flows driven? Is it regulatorily policy driven? Interest rate policy? I don't know if you've stayed with these markets long enough to notice different regime shifts and when you can try to get more aggressive, because I think the long-term trend, like Turtle said, for a lot of these countries has been down. So it's hard to get incremental fund flows from the machine to that, but certainly idiosyncratic companies could be up substantially, or there's other things that could happen. But how do you think about maybe that's a bit of a broad brush too, but if you had to characterize Colombia to a non-Colombian from the equity market, how would you describe it?
Yeah, so bring up a chart for our biggest bank, ticker CIB, because it's been listed like way longer, so you can get a sense of the macro cycle. You see it? CIB?
Oh, sorry. Yeah. CIB. Ticker symbol CIB. Yep. That's this bank you've been talking about, right?
Yeah. Yeah. Bring up a long-term chart.
Yeah. Here we go.
Does it go monthly?
Here we go. Yeah, let's do monthlies. Sure. CIB. Back to 96.
Yeah. So it's been listed in the US like for a very long time. So you had kind of the blow up in 2000 when kind of all the Argentina and Brazil were defaulting. Then you had this ridiculous run from like $1 a share in 2002 up to 70, and that was on the back of oil, because oil is half of the country's exports, sometimes more depending on how high the price is. And so it was just kind of the perfect conditions. You had a new government that was spending aggressively with all the new oil money coming in, and it was a party. By the end, you had like you had like people that were listing stocks having big parties in Bogota. There's so much capital wanting to come into this country. The equity market is tiny, and so it's just like people are throwing all this money at it, but it was just kind of a levered bet on oil. And then obviously kind of since 2014 with oil tanking, you had a long downturn here, and then kind of with COVID when oil went below zero, people wonder kind of what's the future for this country if people don't want their main export anymore. And so now you've got, I think what the inflation rate's like 12% here now, which is not great, not awful, but you've got that to worry about. Everyone's expecting at some point kind of the global recession to hit, which will hit demand for exports. So you've just got this prevailing negative sentiment and then uncertainty with the current government. But yeah, at some point people are gonna want in again, and then like I said, there's like 3 stocks to invest in this country, and this has a market cap of what, like 5 billion. And so if people decide they want more exposure, like Colombia's a GDP of like 400 billion, and the 3 primary stocks have a market cap of like 40 billion combined. So it's just a pathetically small equity market. But I guess, as you know, whenever people want demand, Wall Street will find a way to
I mean, yeah. And knowing nothing about this company, but hearing some of what you said, tracking oil, tracking macro, I think at $20, you're starting to get a really nice margin of safety. You know, if it ever gets back to that $16 to $20 mark, as a proxy for Colombia, I think, you know, you can make an argument that some macro allocator might take a flyer.
Yeah, it's interesting. The company just has a historical tradition of paying half of its profits out as dividends, which has resulted in the dividend yield being 12% now. And it's not like, it's not their strategy to pay that high of a dividend yield. It's just no one wants the stock, but profits are
sometimes
still
with
high.
foreigners, there's some withholding tax and some complications. But I think for the individual, I think if you can deal with that, that's not too bad.
Yeah.
What about,
Hey guys.
oh, go ahead, Jimmy. You got a dip?
I got a hard cutoff, but this has been fascinating. I think this is something we continue over Twitter, over this conversation. But I want to pick Ian's brain a little bit more. I'm going to read a couple of your articles, and we're going to keep having this conversation.
Hell yeah, man.
Oh, yeah.
Hey, great seeing you, Jimmy.
Yeah,
right,
for sure.
Soon, all right.
Catch you guys, bit.
Yeah, later. Ian, if you still got a couple minutes, let's shoot the breeze a little bit more, huh?
All right, sure.
Cool. Yeah, we'll get you out of here pretty soon. So CIB, cool. And so basically, like you said, it's a sliding dividend. It's not the dividend's fixed, and they're just paying out all their profits. What about, I've seen you've been publishing on EC, ticker symbol EC, listed in the US. That's kind of like an oily version of this, right? So let's check that guy out. This is is it Ecopetrol, is that how you say it? And that's a Brazilian, they have government owned, is it state owned, or talking about this guy?
Yeah, the state owns 88% and privately 12% is held. And so the thinking is it's safer than other assets because the state isn't going to destroy their own asset, whereas in South America, you never quite know when resources are going to get expropriated.
Yeah. And so
and then,
what about,
and since the state owns 88% of it, virtually all the dividends it pays goes to itself. And so they're paying a very generous dividend. It's trading at like 4 times earnings. And the government's just like, hey, give us that money. We need it to pay whatever for the treasury. But then obviously the foreign shareholders are entitled to the dividend and that remaining tiny slice of the company that's publicly listed in New York.
Yeah. And so you think the dividend's safe?
I mean, to the extent that you have a view on oil, I don't think the global economy is going to like crash and burn, which I don't know. It seemed like people were getting very pessimistic on oil demand when we hit 65 a few weeks ago. But assuming there's reasonable demand for oil, profits should be fairly stable, I would think. And I just, not a strong recommendation on the bank. I just wanted to bring that one up just because it's been listed since 1995. So I think it gives you that kind of sense of the long-term cycle and just the fact that there are actually companies that are stable here and can operate for 30 years with a New York ticker and have paid dividends virtually the whole time they've been listed, and kind of gives people a sense that there are assets that are not fly-by-night stuff.
Yeah, no, totally.
Yeah, because this IPO'd in the US when I was 7, so that's crazy to think about.
Right. Yeah, it's interesting thinking about. So the big one you hear about, people talk about on Fintwit is PBR. Also New York listed, also a giant Mount Fuji pattern, and also you're going back in the time machine. You're getting like 2002 prices. Also, like these other names. Maybe we can shoot the breeze on that. Have I seen you publish on? I don't think I've seen you publish on PBR. Have I?
No, I don't have as strong of a view. I don't speak Portuguese, and so it's harder for me to follow the local politics. And unfortunately, politics have been very important with that one. You had a huge corruption scandal in the mid-2010s. So huge they were bribing folks around South America. It's like 2 different stocks I owned, so I got hit as collateral damage. They problems. But anyway, there's a lot of angry, resentful investors about what happened during that period. And so like whenever you see people talking bearishly on this company, they're like, but the bribes and all. But I mean, different management team now, different government. But I mean, it's a fair back and forth argument in the sense that the bulls look at it and say the assets are very cheap. They've got some world-class offshore stuff, and it's kind of one of the cheapest energy companies on an earnings or yield, cash flow yield basis. And the bears will just say, look at how the assets were mishandled in the past, and can we really trust Brazil? And I think the odds favor the bulls, but I have more confidence in something where I speak Spanish instead of Portuguese to kind of follow the news.
Yeah, that makes a lot of
I
sense.
wish them well. I hope everyone makes money in these South American companies that have been down for so long. It'd be very nice to have a change in overall sentiment.
Yeah, let's do a fun Ian's force rank. No pressure. EWW, EWZ. So EWW Mexico. For the folks playing at home, watching along, I'll pull up the ETFs. EW. So of the top, which do you? Let's go 1 through 4, if you don't mind. EWW, EWZ, which is Brazil, home of PBR. GXG is Colombia. That's the Global X Colombia ETF we were just talking about. Another Mount Fuji pattern. A lot of these. And then the fourth would be the only other one I can think of off the top of my head is Argentina. Is there another one they don't have, like a Panama, Costa Rica? Not to my knowledge.
Chile is ECH and Peru is EPU.
Because they got a bunch of Chile's like a big lithium play, huh? Pretty much.
Yeah, lithium, copper, and some banks.
Okay. And then what was the last one you said?
Peru, EPU.
EPU. There you go. So yeah, maybe just those top 4. EPU. That's interesting. ECH. Mexico, Argentina, Colombia, and Brazil. What would be, how would you kind of rank those if you had to buy an index and hold it for the next, let's say, 2 years?
Yeah, I would say Mexico is my favorite pick. Yeah, if you bring up the chart, you'll see Mexico looks a lot healthier than kind of most of the other ones. I think the big difference there is it's just the constitution of the index. You own much more consumer stocks, you own much more industrials, you have infrastructure in there. And so I think you're getting like these higher PE companies in the sense that they're much more durable assets. And so I just like the composition of the index way better. I think a basket of some of the stuff in Mexico's top holdings, which is kind of, you've got just consumer stuff, industrial stuff, logistics stuff. I think that stuff is way more attractive, and you'll have a much easier time getting international investors to buy those sorts of things versus buying another mining company or yet another emerging market bank. So you look at something like Brazil, and I think to the extent that Brazil has the consumer sort of stuff, that they should fare well. The new government is probably going to focus on spending more money to help with the lower class, which should help stimulate spending. And so I like some of the consumer names in Brazil, but it's just if you're buying the index, you're getting so much oil and so much iron ore and stuff where the P's on those just never really go up.
Yeah, great point. Okay, so Mexico, number 1. Number 2, from an overall index standpoint, and actually, I just pulled up the numbers while we're talking now. Mexico's 31.5% consumer staples, and Brazil's 8%. So to your point, which of those 4 would you put as like the second one, if you had to kind of a longer term?
Yeah, Argentina is unique and idiosyncratic because like 20% of the ETF is Mercado Libre, which was the e-commerce company, which has been tremendously successful. And so
it's the only LatAm stock most of Fintwit knows about, pretty much.
That's true. But yeah, if you're bullish, kind of more on the tech side of stuff, there's also some companies like outsourcing companies and software stuff out of Argentina. And so you've just got an interesting tailwinds there because it's not just a bet on Argentina. It's like kind of where the LatAm tech stocks are. I'm reasonably, I'd say I'm upbeat on Argentina. It's already rallied quite a bit. It's new all-time highs, actually. I think you've got an election coming up later this year, and it looks like the conservatives should take back power. So there will be another rally with that. But that's a trade. That's not a hold forever. Argentina,
Peter
you can never
Zahan.
rely on Argentina politics for any length of time.
Peter Zahan, the global politics guy everyone loves. You've read any of his stuff? He's he's a big Argentina guy long term. He's kind of he likes the 30-year outlook for the Argentines. But yeah, it's good stuff. That's really interesting. The Mercado Libre point is really interesting. That's a stock I don't see talked about as much. Probably because the price action, if I had to guess. Let's take a look.
It did one of your Mount Fuji's.
Oh, but this is the most Mount Fuji's. This is what 2023 looks like. We are so back. Yeah, there we go. Cool. Let's go here. So I mean, I'm scratching the surface. The very, very tip of the iceberg of your Latin America knowledge. For anybody paying attention to home, you highly recommend Ian's Insider Corner on Seeking Alpha. You should sub to his stuff there. Substack. How do we find you on Substack?
Yeah, so just Google Ian's Insider Corner Substack, and it will come up.
Same name. Got it.
Yep.
The last thing that you've been publishing on that I really want to pick your brain lately is the land banks. You had and I want to, I want to go deeper on the LatAm stuff over time, or have you back on is what I want to do. Whether you want to come back on or not is up to you, but I want to have you back on and pick your brain more on the LatAm stuff, a little more in depth. But let's go. Let's transition to these land banks you've been publishing on. Recently, you published on MLP, Maui Land and Pineapple. It's a home ranch. JOE is a Fintwit favorite.
A Cuppy favorite. Yeah.
A Cuppy favorite. Yeah, that's right. So yeah, kind of why do you find interesting about them? Maybe start there. About these.
And to be clear, I don't own any of these at the moment, but I find them interesting as long-term assets, just kind of as a different way of approaching the inflation game. Because people are always wondering, like, what can I own that might make sense to protect kind of if we go back to a 70s style higher inflation. And obviously, like some people like gold or like Bitcoin or whatnot. I tend to prefer assets that can generate some income. And so ideally, if you own land and then they can do ranching on it, or oil rights or water rights or what else, you can potentially get your inflation protection with more kind of more juice to the upside. But unfortunately, a lot of them are run like country clubs essentially, where insiders just pay themselves and then they never do anything with the land. It's like this one that you have the chart up here now.
Yeah.
You've got Steve Case, who owns the majority of it and just seems to treat it like his private island in Hawaii.
This is Tahone.
No, this is the California one. Sorry.
Yeah, same thing, but just different names. Yeah, same story. Insider.
Yeah, this is the one. Yeah, this is the one that owns a ton of land, like 50 miles outside of LA.
Yeah,
and people are always like, it's 5 years away from being subdivisions. And
yeah,
I was kind of debating it with somebody, and they were saying, no, we've only started thinking that we're going to develop it soon. And then I showed them an LA Times article from like 1988. They're like, there have been recent setbacks with permitting, but we're still optimistic we're going to have bulldozer ready from like 1988.
Right.
How's that going, guys?
Yeah, exactly. Yeah, no, that's funny. This is one that's it is. I mean, a lot of Californians, if you drive from Northern California to Southern California or vice versa, you drive what's called the Grapevine, which these guys basically a big chunk of the Grapevine, or they own a lot of land surrounding it. And the most profitable Starbucks in all of California is one, is it some rest stop that they lease out to tenants. And so now, to your point, it's one that's no one's really ever made money on, but it is a very interesting, way of looking at owning inflation. I think it's what's interesting about real estate, and why I have this YouTube show with Jimmy, is because Jimmy's an expert in REITs. I mean, he understands REITs at a very in-depth level after covering them on the buy side. And I think REITs are interesting because it started with where people say about oil, and it's like, what's so interesting about oil is it's where the physical world meets the paper investment world. I mean, I'm not doing it justice, but it's like it's where like you have to demand, you have to deliver physical oil, right? Somebody does. And so that price has to be real. And so I think there's an element of, you know, we've all just, or not, I shouldn't say we've all, I have just seen so much blood in the last 2 years of just, you know, where 2 years ago, the risk was missing out on the next GameStop, right? It's like, that was the risk, you know, managing other people's money or, you know, with your own account, the FOMO of missing the next GameStop when it was so obvious the shorts were going to get squeezed or whatever. That was the concern. And now it's like, anything you were buying at that time, does it have any value? Is there a business there even? And so my point is like with real estate investment trusts and with these land banks and stuff, you are literally, you know, well, in this case, you are literally buying land. And you can, for Tejon Ranch, there's some articles. There's a guy, I think his name's Harrison Schwartz. I think he's on, I think it's his last name. Maybe that's somebody else I know, but I think it's a guy named Harrison Schwartz on Seeking Alpha. And he even like broke down, okay, I analyzed lots in the area. So you can go, I think Tejon Ranch is in Lubbock, California. You can go look at Lubbock and say, okay, what's an acre of land going for? Well, here's what it is worth on Tejon's books. And here's on average what, you know, that what on average they're essentially some of the parts would be worth if each acre was worth what the current market value is. And again, you can kind of backwards. So there's an element that's more real there, right? Or more tangible, of course, than a software product or something that can kind of, you know, fly away overnight. And so, so yeah, blah, blah, blah. They're super interesting canaries to watch, I think.
Yeah, and with the return of inflation is something that everyone has to kind of consider in their investing process again. I think people might kick the tires on these. And so if sometimes you look and you're like, why did the stock go up in, call it 2011, for example, you see a spike and you're like, oh, someone published a blog post about it.
Right.
And a bunch of comments. And so you can kind of even see kind of at the moment when the investing community found these interesting or not interesting.
Totally. And I think you can learn a lot about corporate, you know, being a corporate shareholder, because it's, to your point also, is like there've been, you know, the case study has been these guys have, when the guy writes the blog post and the shares spike, then the first thing to do is turn around and issue a bunch of stock. You know, that's been, to your, if you pointed out in some of your articles, it's like these guys have not, or not, well, both of these companies that we've actually put on the screen here, they've both been corporates of issuing shares historically, and that's essentially how they've funded their operations. There's not much of a business there besides issuing shares. The stock is the business. So Maui Land and Pineapple, you're a little more constructive on. You don't own any shares, but you're a little more constructive on. Is that fair?
Yeah, I think we've seen more concrete positive signs in terms of them actually having a path to development over a reasonable time frame. We saw a change in management where it appears that they're going to be more aggressive in terms of trying to development. And then the price, I think I published that around 950, but it was kind of the lowest price since the last round of enthusiasm around the stock in 2017. And so I think you can very easily get to an NAV well above the current price. And so it's like, maybe the stock keeps being dead money for many more years. It certainly could, but it was just kind of an intriguing thing where I'm looking at it like, I think at this price, you're going to have a very easy time making a favorable NAV argument for shares being worth a lot more than here. And there are some positive developments on development. And so it's just like, this is quite a bit better setup than it has been in the past.
Yeah, no, and these lines here for the viewers at home, it's the you know, the idea is like the PWL is the pre-Wu flu level TM. That's Dr. Jin. If you guys follow him on Twitter. But the COVID lows, it's like, look, if you're buying something in general, if you're buying something at the same price it was during, you know, the depths of March 2020. You might be getting a distressed price. I mean, you might not, because there's other stuff going on besides just, you know, there's other stuff going on, but that's, you know, that was definitely a depressing time. And so you could be getting a very good deal. If you're buying something at the same price it was in March 2020, you might be getting that's an interesting interesting price for these securities to kind of revert back to. And so, yeah, well, that makes a lot of sense. And to your point, look, so far so good. So seems to work. What about the third? Well, and there's plenty of these guys. And I found some full watch lists and stuff some guys have, and there's a bunch of stuff in Canada you can look at. There's one in New Mexico. It's like a home builder pure play just in New Mexico you might know about. But anyway, but JOE, the St. Joe company, that's another, like you said, Cuppy originally brought that to my attention, but now all of Fintwit knows about it and talks about it. Do you have a take on this one? I haven't seen you publish on it, I don't think.
No, actually, I was going to comment that Kierstyle, my prior employer, published a short report on it a while ago, and so I've just decided not to cover it because I didn't want to step on what they were doing. But I've thought both the short reports and the bull case are both interesting. So I think there's plenty for folks to dig into, but not one where I have a strong opinion personally.
Yeah. And what's your, maybe the last thing we kind of wrap on is like, what's your trading style? Like you're a very prolific writer. Do you trade as much as you write? Are you more long-term buy and hold, or kind of tell us a little bit about your trading style?
Yeah, I'd say probably 70%, like 2/3 of my capital is in very long-term stuff that I try to sell as little as possible, kind of keep turnover exceptionally low. And then put more active trades on for stuff where I have a shorter term view or playing something like relative momentum or whatnot, but that's a much smaller portion of my work. But if I was just going to say, just carrying over from the Latin America, like the last thing I wrote up on Substack is kind of interesting for one of the more timely thematic sorts of trades. Bring up ALB if you can bring up the chart.
Absolutely, yeah. This is our this is like a lithium play.
Yep. Yeah, and so it operates out of North Carolina, but they have sizable assets in both Australia and Chile, in addition to the US assets. And they have a contract with the Chilean government to keep producing until 2043. But then last week, I guess a little over a week ago, Chile announced its plan for giving out process for permitting for new lithium deals that companies will have to comply with. And so Bloomberg originally reported this as Chile unveils like public-private partnership plan for lithium, but then some wise guys at the FT decided to report that it was nationalization, which is, I guess, technically true to the extent that now you're going to have to work with the Chilean government to get permits, and the government wants participation on new lithium mines. But everyone just saw the word nationalization. They're like, oh no, Venezuela, Hugo Chavez. And so these stocks got bombed out. It's like, particularly in the case of this one, you've got like a ton of production that's not in Chile for one thing. And then the government said they'll honor the existing contract for the next 20 years. So it's like, really, what's your DCF? Like, how much of your future cash flow were you expecting from beyond 2043 anyway? And bring up a daily chart, because this thing just got whacked. And I really believe it's just this irresponsible media headlines.
Yeah.
Look at the wick on the candle.
Yeah.
So I just mentioned to my followers, like, I think this is ridiculous. I was looking at some of the options, and they had high IV, obviously, because the thing was down from 200 to 175 virtually overnight. So people are just like, the panic, get me out. Oh no, my assets are being expropriated. Like, calm down. The government is not doing what the media is portraying. But then you get everybody like Zero Hedge, and everybody's just going out and like another one goes communist. And people are so emotional about this sort of stuff, and they weren't really thinking about that there was anything to worry about here. And so the moment the media kind of uses scary language, you get a calamitous sell-off like this. And so I just highlighted that. Some subscribers find those sorts of quick call outs, trade ideas valuable, and others are more interested in the longer term ideas. This isn't a company I would own forever, but it's something that I think is quite out of favor compared to where it was a few months ago.
Yeah, and what if
figure out the news should rebound to some extent?
Yeah, and what if you're short Tesla, right? Like everybody, so this is maybe like I mean, that's people, Tesla trades with lithium, right? And so you've got something, a similar, definitely, you've got a strong correlation there. And so maybe you could, pair it off or something, I don't know.
Yeah, I appreciate you bringing that up. I never traded against Tesla, but it's a very, very high correlation.
Yeah, right. And so that's interesting, but to your point, you've got the idiosyncratic like government risk and that and then you got Tesla getting taken to the woodshed here the last couple of weeks, and so maybe you've got something to trade against there. What about so and then this, what I really liked about so people can find you on the internet, check the Substack out, check the Seeking Alpha, but then do you do work like are you like a hired gun for hedge funds and stuff, or is that, can you talk about that? What if we have like an institutional guy watching this and he wants a LatAm Max, like that services for sale, or?
Yeah, I've done reports on individual companies for funds where they just say, do your diligence on this, and we want to write up, kind of going through the positives, negatives from your experience, that sort of stuff. Always happy to do a individual report. I'm not sure, like I would talk to anybody in terms of seeing if there'd be any overlay there. That's what I really like, being an independent publisher and having my business here from South America. So I would not be interested in going back to an office in New York, but to the extent there's consulting, yeah, always happy to take that call.
I'm interested in coming down there, man. I don't know if you got room for a plus, maybe like an ADU in the backyard, but you guys probably have different zoning laws there. Here's some international emerging stocks on the current Swami signal. The Swami score is a strength of signal. Takes into account price, volume, volatility, the Hurst exponent, and is looking for price memory, and where and look, and really what we're looking for is stuff that has a strong tendency to continue drawing down, right? And so Mexico looks good. That's kind of the point for now. Mexico looks really good. Any technician can pretty much tell you that, but that's or Ian. But that's the point there. Brazil was looking a lot better recently. When I reached out to Ian, Brazil was our top international signal, and then as energies backed off a little bit, it's kind of the signal has waned.
Yeah, that's kind of what I was saying with the different compositions of the indexes. Like Mexico has resources, and so
yeah,
there would be some stocks that have sold off in Mexico, like just like everything else in Latin America is sold off, but all your consumer names, all your industrial names, all your logistics names, all that stuff doesn't care that the price of oil went down. And so it gives you a lot more resiliency in Mexico.
Yeah.
And I think like you look at the longer term chart and it's really started to come up quite a ways. It's still off the 2013 highs, but it looks very constructive in terms of this is kind of a fresh 8-year high. We've seen rising volume. It feels like people are starting to say, do I need to allocate here? Because like if you're the average guy in London, let's say, who hasn't thought about Mexico, like unless they're playing the World Cup, now it's like, do I need to own some of this? Because I haven't thought about this country in a decade. And I think people look at it and say, this is actually a pretty good index in terms of having a lot of companies that make sense. There's fewer ESG problems than you'd have with most of the other countries down here. It's something I think a lot of people can own just once they take a look at it, and kind of the price forces people to look at it now that it's been up enough.
Yeah. Why on the ESG thing? Before I was going to say what do you mean by ESG? Why Mexico has less ESG than Chile, or ESG concerns?
Just because your top holdings aren't mining companies or oil companies, and so anyone that looks at EWZ and sees Petrobras as the top holding is probably going to say, that's, and Rio Tinto mining iron in the Amazon and all. It's not
right.
A lot of people are really looking for exposure to in today's political climate. Yeah,
that's right. I forgot. Sometimes corrupt energy companies is not exactly ESG. It's the definition is always changing. XLP, to your point about Mexico's score is 60, XLP is 65, right? And so, because that's you're right. That's probably a lot of what it's picking up. The other thing it might be picking up, the Swami score might be picking up, is the currency. The Mexican currency, the peso, has been very strong lately, And there is no currency ETF that I know of, at least. There's no way to play the Mexican currency or the Mexican peso sitting from your mom's house, young
There
trader.
was a Mexican peso currency. They shut it down right after Trump won and the peso devalued, kind of on election night in 2016. And since that point, like the peso has been the strongest currency in the world. Like, it's appreciated like 20% since Trump's election, which is just wild.
That's pretty funny.
USD,
USD
MXN.
MXN. Yes, yeah. That's pretty funny. Yeah. So maybe but yeah, it's just so the question there is like, but buying EWW is kind of a way to, here you go. So basically here's Trump election.
Lower is stronger, higher is a weaker peso. So obviously you can see kind of as it's been going down, that means it's stronger versus the dollar. Yeah.
Right. So here's Trump won the election, dollar appreciates.
No, that was COVID. Back up a little bit.
Oh, yeah, you're right. Yeah, I'm tripping. Yeah. Let's find Trump in here. So what Trump won in you're talking about in 2016.
The end of 2016.
Yeah, okay. Yeah. Okay, here you go. Here's your gap up. Yeah, boom.
Yeah. That's
gap
when all
up.
the hot money exited. You kind of see like fund providers saying, oh, we don't really need a Mexico fund anymore. And then that was a great buying opportunity.
Yeah, look at that. That's funny. And then especially since COVID, I mean, this thing has just been on a one-way ticket to midnight. So
because there's the reshoring, which is good for the US and good for Mexico, but it means much more to Mexico than the US just because of the base effects. Like Tesla puts a few $billion plant in Mexico, and that's a huge impact to their local GDP. Whereas if Tesla builds a new plant in California, it's just like ho hum, because there's already like it's base effects, right? Because the US already has such a large industrial base, and now when the US is trying to shift a significant chunk of Chinese production to Mexico, you're just creating a ton of incremental change. It's like almost every week we see a new $2 billion steel plant going in. Oh, Hershey's doubling their production. Nestle's building more. And so we just see these headlines like every week, and it's obviously a lot of money needs to come in to pay for all this stuff. And so it's been a strong tailwind for the peso. Yeah.
No, that's a secular bull market. The last question for you. So yeah, I mean, look, if you're trading these for 5 years, maybe you don't have to, or if you're going to own this, it depends on what you're looking to do with Latin America. What I recommend you do is you talk to, don't go on a safari by yourself, talk to a jungle guide like Ian. He'll keep you out of trouble. But when you're buying a Latin American stock or any foreign stock, you're taking currency risk, because all these ETFs we're just looking at none of them are currency hedged. And so you're taking currency risk. How should people think about that? Or should they, if you're collecting a 22% dividend, like an ticker symbol EC or something, you're not, how worried are you about a couple percentage currency slide here and there? But anyway, that's a statement in the form of a question. How do you think about currency?
I got you.
Yeah.
I'd say if you're investing on a long-term time frame, the currencies here kind of always end up reaching the same purchasing power, kind of in comparison to dollars. And so if you own companies that like you're there because you want their earnings and you're not just doing it as a momentum trade, the company's earnings should eventually reflect the exchange rate. One thing that like to say, I've lived in Latin America full time since 2014, and essentially a beer has always cost like $1 pretty much anywhere I go. Like any country in Latin America, it's always around $1, give or take 10 or 15 cents. And so regardless of if it's Argentina with a 70% inflation rate, or Mexico with a 3% inflation rate, or some country like Ecuador that actually uses dollars as their currency, prices always end up like gravitating to the same level. I think it's based on just kind of people's purchasing power. And
it's the Modelo index. For the Big Mac index, TM, this is the Modelo index.
Exactly, yeah. So this is kind of a roundabout answer, but I would just say if you own these assets because you like the assets and you want to own for a while, I wouldn't sweat the short-term currency fluctuations too much, because just generally earnings will like if the currency devalues a lot, then earnings go up a lot. just from being more competitive. So what was the other thing I was going to say? Oh, yeah, and just the other point I was going to make is that when you hear people worrying about currency risk and kind of how this is something we need to worry about, that's usually happening after the dollar's been strong for a long time. Whereas this feels like a very recent problem since the dollar went up in 2014, 15. Now people can't imagine the dollar going down. But if you think back to like 2001 through like 2008, the dollar went down like every week. Like,
Yeah.
where the dollar just got trashed for so long. And there people wanted the foreign currency exposure. They're like, I need to get out of the dollar. Yeah, like just look at that. Look at that on the Brazilian real. Like I was saying, pretty much every week the dollar was losing value, and people just like,
Wow.
I can't hold dollars. Dollars
For
are trash.
years.
And so
Into a crisis too. Like this is like, can you imagine? Like, yeah. I mean, yeah, that's crazy. Keep going.
Isn't that a wild move? It's more than 50%, right?
Yeah.
I can't see that. What is it like?
Oh yeah, I got my
150.
yeah, I'm blocking it. Yeah, it's a big move. It's a big move. I can tell you that.
Yeah, and so if you own an EWC during that sort of thing, like the value of your stocks doubled just from owning them, just from like the currency translation, even without taking into effect that the companies were probably making more money because of whatever the positive tailwinds that were contributing to the currency view. I guess that's how I'd sum it up. It's just like if you bought companies where their profits are going up, the currency is probably going to do all right as well because you've got good fundamental tailwinds. And if the currency is going down, then there's probably something else wrong with your thesis. And so I wouldn't make the currency the main part of my equation. It's like I need to get the assets right and the political risk right, and the currency will take care of itself.
I like that. Yeah, that's a good place. That's a good place to end it. Yeah. Dude, yeah, I appreciate you, man. Thanks for coming on. That was a lot of fun. We'd love to have you back on sometime and enjoy your Friday with your family there in beautiful South America. And thanks for coming on Real Assets Weekly. And yeah, that's definitely, guys, check out the Substack, check them out on Twitter, and check out the Seeking Alpha articles as well. Ian Bezek, it's been a pleasure, my man, and have a great rest of your Friday.
Thanks, you too.